Broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. Can everyone see my screen and hear me? Perfect. All right, let's go ahead and get started. Since I didn't see any questions yet, we'll just go ahead and start going through the equity markets, and then we'll move on to the other things we usually cover. But again, as a reminder, the purpose of the Beginner Circle webinars is to really help out with people who are new to the sites and new to Elliott Wave, get a little bit better acclimated, answer some questions about the different services, and everything else. Oh, perfect. So Mr. Monopoly has a question on log versus non-log charting. I guess we can just click this button here at the bottom. Garrett and I think Jason and Michael also really use log scale in most of our charting, particularly when you're looking at individual sectors and definitely with regard to individual stocks, a lot of them that went from very low prices to significantly higher prices, that without looking at things in a logarithmic scale, you can get a whole lot of distortion. So looking at longer term views of equity indexes also, we think it is very helpful to look at that in logarithmic scale. When you're dealing with large price instruments that on the whole are not moving by such huge magnitudes relative to a lot of other things, then a linear scale at a smaller time frame can be just fine. But here's what happens to the move from 2009 lows into the current highs as we've seen them in January 2022 when we switch it to linear scale. This fifth wave becomes a lot bigger in magnitude and the rest of the move flattens out a whole lot more, because that's where we went from the 2200 lows after COVID all the way up to 4800s. So that is more than a double. So on the logarithmic scale, that shows up as a much bigger magnitude move than when you look at it in terms proportionate to the rest of the other move in terms of logarithmic proportions. Then it looks like a much more normal fifth wave. But because there are a lot of people that look at things in linear scale, then you could more easily see why so many people were very convinced that this was all of the move. And it may very well have been. I certainly lean towards this being all of the primary degree wave 5 that we were looking for, not because we have the best subwave count, and we'll look at that in just a minute, but more because of the proportion of the move down relative to any of the other consolidations that we got off of that 2020 low, the COVID low, but also just because of that it looks like 5 waves down now, and just looks a lot more disproportionate and less reliable to be looking for one more higher high. I know that's still obvious primary count, although he's added the alternate in red that we did top at this larger magnitude move. Garrett and I are leaning more towards that, looking for only a corrective bounce. And we'll zoom in and talk about that in a little bit more detail. But I wanted to point out a few other things on this chart before we move on. So the correction that we're looking for here, and I'm going to zoom out. I don't know if I can't easily hide my blue lines there and some of the notes that are larger. But if I wanted to zoom out to the monthly, where you can see that this super cycle degree wave 4, that we are either starting or starting after an attempt at one more nominal high, is corresponding in magnitude to the supercycle degree wave 2, which was the 1929 crash into the 1930 lows. So from there, inside the 1930 lows, we have a cycle degree wave 1 and wave 2 into the 1940s, and then the primary 1, 2, 3, 4, 5 all the way up to the 1999-2000 top. And then the cycle wave 4, which is our big ABC expanded flat that includes the 2008-2009 financial crisis. And then the cycle wave 5 that easily counts complete as a primary 1, 2, 3, 4, 5 waves up, with primary wave 5 coming off of that COVID low. So Monopoly asks, from 2009 to now, we're at a 382 versus a 0.50 for retracement. Does that matter in terms of levels for sentiment? I think in terms of measuring a retracement of this entire move, particularly in dealing with linear scale, it is really those aren't going to be the guidelines that we're going to use. I want to talk about some of those guidelines for what this fourth wave should look like longer term, and what we're looking for in the shorter term. But in terms of a retracement of just this move, that's not really going to be the most applicable fib measures. So this cycle degree, super cycle degree wave 2, was a very, very deep and very sharp move down. So by Elliott wave rules of alternation, our fourth wave here has a really good chance at being a wider flat and maybe holding a higher relative Fibonacci retrace, similar just back into the same price territory of this wave 4, which I'm going to zoom back into the weekly view. So, well, let's actually go to 2 week so we can see all of this on one screen. So we know a couple of guidelines for where a fourth wave should hold as support. One is in the region of the fourth wave of the subwaves inside the prior third. So if this is the supercycle 4, then we're looking at the cycle degree wave 4 inside of supercycle 3. So that gives us somewhere in between this 1600 to 660s, which is where the cycle wave 4 bottomed. So that is one area of guideline support. We also know that we can look for a Fibonacci retracement levels of that third. So we do have a 23.6% retrace at the 928 level. And then we also know that when we have an extended fifth wave, usually the fourth wave is going to fall somewhere in between the wave 2 region of that extended fifth, which puts us closer to a 1200 to a 1000 level, which, it kind of seems very esoteric almost that to be talking about those kinds of levels when we're in the 3700s. But the bigger thing, that takeaway that we want to see is that this should be a much bigger ABC flat, more similar to what we saw from 2000 down to 2008, but just a larger magnitude than that. So it can take at least a decade or more to fill out the rest of the way. And it does look like we have just the first 5 waves down in what can be the intermediate degree A wave of the primary degree A wave of the cycle A wave, which I have emphasized in red here as this larger ABC correction. So moving on into greater detail, I don't have the cycle and supercycle degree labels on this sentiment stages chart, but here you can more clearly see that how this looks in relation to anything that we would count as the wave 2s, and how much bigger that is, that in terms of size and scale, it is on par with either of the A waves or the C wave inside of our primary degree wave 4. So it certainly seems at a much larger magnitude than is reliable as a fourth wave still inside this primary wave 5. But I haven't deleted the green alt 5 yet because it is still possible. We are at a 618 retrace, and you do have to rely on counting this as, I think, a WXYXZ, which is a less common and less reliable pattern. And so if we were going to see a move to new highs instead of just a B wave, I would also probably lean more to that being an A, B, C move to new highs as opposed to a 5 wave move up. Also because we have Depending on how you count this, either you can count an A, B, an extended C wave up for wave 1, and then an A, B, C for wave 3, and then count this as the fourth of a diagonal, or even A, B, C up here, and an A, B, and a stretched out C wave for the third, and count this as a diagonal. But you are getting dangerously close to some overlap, depending on how you count. If you count wave 1 up to here, then you definitely have overlap. If you count the smaller wave 1, then that creates some other issues. It's certainly in terms of magnitude, with this being a fourth wave. But if you count the smaller wave 1 as 5 waves up, and then 5 waves up to here as the third, you don't have overlap yet. So you could get maybe an ending diagonal to a nominal higher high. But I think what is more prudent, particularly because off of the, I renamed my my tab. So on this chart, I still have Uber accelerated bullish count, but I actually renamed that on my SPX chart as the what's the frequency Kenneth tab. And so on that, at the smaller degrees, as posted earlier today in the site, we have only 3 waves up that I think counts better as an ABC move up, working on consolidating in what can be just a B wave, and then setting up for a C wave in a larger A of a corrective move off the low. So let's see the macro clean tab here. There we go. So again, while this could be a fourth wave, and we can be getting a move to a nominal higher high in the 4,900 to 5,000 region, there's a good chance that would be as an ending diagonal or even an ABC up. So I think looking for only a corrective bounce is more prudent here, instead of relying on a more bullish move to new all-time highs. So that doesn't mean that I'm discounting the potential that we could get a move to new all-time highs. It just means that my primary expectation is that we will only get a corrective bounce, and that will look more like an ABC move up into resistance in the 4,200s to 4,400s, and then a larger move to the downside. Right. So, Robert, basically, in trying to align what Garrett and I are seeing with what Avi's been showing, is that even though we differ in terms of what we lean towards, whether this being a major top or getting one more high, we're all looking for more of a corrective more of a move off of this low. Just Garrett and I are leaning more towards that being a corrective bounce, as long as we can hold support off of this more immediate low. So I'd like to see at least a larger ABC move up towards 4260, ideally with the A wave getting to 3950 to 4100 region, and then holding a B wave retrace and then getting a wider flat before we head down into later next year, or even into finishing up that move into 2024 even. There is more of an immediate risk, though, that we count a more normal ABC move down. This is the B wave, and then there are some charts that Garrett and I are looking at where this can either count as an ABC down for wave 1 or even 5 down for wave 1, and we only get a corrective wave 2 bounce and then head more immediately lower. So I have that in kind of this darker faded red, but it is lurking in the background. So it is very important as we look for the smaller degree counts off of recent lows to hopefully see this move in more of a corrective, in the start of more of a corrective manner, that we hold support along the way. So this basically, the smaller degree purple A wave here is more of a nod to this being a smaller degree A, B, C for the A wave, and then getting another B and a C wave up closer to 4,100 for the A wave of the parentheses B. Whereas we did come up enough that a more measured normal retrace here and a measured move can get us to that 3950s region, which we said was kind of the minimal target that we wanted to see for this A wave of the bigger parentheses B wave flat. At the smaller degree, we can see at least another drop as 1, 2, 3, 4, and getting a fifth wave down for this C of the circle B wave, and that takes us to the top of our normal fib support region. But that could easily be just an A wave and then a B wave and a C wave down closer to the 3620 to 3600 region for that circle B wave, and then heading up towards 3950 from there. And then following that same thing I mentioned in the ES, that we look a little bit closer, like we might be closer to completing as this ABC flat for all of the B wave. I have this at the smaller degree, as mentioned, where a move up towards 3950 could be just the A wave of a larger A targeting the 4100 region. I think I would prefer that a little bit more, but we're kind of in between both of those on the SPX. So ES leans a little bit more to that, to still being the smaller degree. But at any rate, we really want to see the 3600s hold. So Carolyn, as I was saying, yeah, if we are getting another high, then it is much more likely that it's only going to get nominally higher than the high that we saw in January 2022, closer to just the 4,900 to 5,000, maybe 5,100s, as Avi's mentioned. That because that fourth wave, if it is still a fourth wave, dropped so much deeper, then it is just much less reliable as a fourth wave. When we were holding here and it was possibly even a smaller degree 4 and getting another fifth of a third and then another 4 or 5 higher, then looking for 5,500 to 6,000 was a very high probability. Getting a move towards 5,500 from the May low was also still a pretty high probability, although it was less ideal. Dropping to the June low really started to call that into question, and then breaking that June low again really makes that an alternate count for me. So Mr. Monopoly says, I know you said it's esoteric, but do you guys think about the reasons why and how we could get to below 1,000 to 2,000, for example, a global crypto run? I mean, in the socioeconomic theory of finance that Prechter wrote, there's a lot that goes into the psychology of macro trends and that we see displayed in the price patterns. So the Elliott Wave principle is a really good textbook for learning how to apply Elliott Wave to charts. His socioeconomic theory book is a much larger and denser book to get through, but goes into a lot more of the theory of human emotion and how that manifests in terms of macro trends. So, certainly we see issues with bond markets, we see issues with fiat currency and just global tensions. So, a lot of different things can happen. Some of them can be pretty scary. So hopefully, we'll be spared from some of the worst of that, but certainly some interesting thought exercises there. I can't, there'd be better questions for Avi and Lynn. All right, let's move on to the NASDAQ, which is just a little bit different in two regards. One, we started to consider that this was the more significant top in the NASDAQ when we failed to hold the March lows. That was already starting to flip and pivot the potential for one more high once the setup off of those March lows failed, and even more so as it failed the May low to get to June. It possibly was trying to get a stick save, but then when we couldn't get 5 waves up and hold a corrective retrace, then really had to consider that was a more significant top. But the major difference in the NASDAQ from the S&P is that the NASDAQ made a higher low in 2008 from its low in 2002, which was 5 waves up and 3 waves down. So it has an extra cycle degree wave 5 that it should get off of that 2002 low. So whereas this is the start of a super cycle degree wave 4 consolidation in the S&P and the Dow, this looks more like it is just a cycle degree correction, fourth wave, in the NASDAQ. At the smaller degree, though, it looks like the same leading diagonal down for an A wave and working on the B wave bounce, which should really target the 14,000 region and then set up for a drop from there down towards 8,000 or maybe even lower. Off of the low, though, it does look very, very similar to what we just looked at on the ES. Ideally, the smaller A and B inside the minute degree A wave of the minor degree A wave of our parentheses intermediate degree B wave bounce. All right, let's move on from equities. I know we could, well, let's look quickly at the equal weight version. I think the equal weight NASDAQ certainly agrees with the broader NASDAQ that this was a more significant top of all of the primary wave 5, and we're working on a B wave bounce, but this does show that same risk that we talked about, where this was a B wave and we're in the 1-2 start to a C wave down already. But even that red wave 2 should get more of a B wave consolidation here and a C wave up towards the 91-92 region. RSP, on the other hand, is probably the best argument for, other than a few individual sectors that Garrett and I cover in stock waves, for this still being a fourth wave and allowing for one more high. Fib-wise, it is still holding the 50% retrace region. It does have to count as a WXYXZ if it's going to be a fourth wave at the October low. But we can certainly consider that more because of the proportional move relative to this wave 2 is still very, very large. But fib-wise, this did not get past a 1, 2, 3, 6 extension for the third, but is still holding a 50% retrace for the fourth. And the 200% fib at the larger degree would still be a very nice target, close to 186 for one more high. But that all hinges on that October low holding. I'm not sure exactly what you're asking in terms of what Avi's asking and talking about on the MACD. That might be a really good question to ask him directly in one of the morning live videos, possibly. All right, let's move on to energy, and then we'll look at metals. Oops, there we go. So I'm willing to consider that this was a third wave and not all of 5 waves up in oil. But a lot of the oil stocks and the ETFs and a lot of other things like the gas ETF that Garrett and I are looking at still look like they have more downside to go in a larger fourth wave. So I was tracking this ending diagonal, and we can squeeze in all of the subwaves to have the ending diagonal for the C wave complete here. I know this chart's a little bit messy, but we can get these yellow subwaves in place as, we'll just change them to gray here, but as 1, 2, 3, 4, and 5 to normal fib extension for that C wave. But we only got a clear ABC move up off of that low. So what I really think this is, instead of this being a C wave, either this is 1, 2, and this is the third, and this is the fourth wave, and then we're going to get an A, B, C wave move down for the orange 5 of C, which I like a lot. But also Garrett had posted the potential that this was, instead of a C wave, was a Y wave, and that this is the A and the B wave of that Y wave, and this can be 1, 2, and we get an A, B, C move down for the third, a big bounce again for a fourth, and then another A, B, C move down for the fifth. So I like that a lot with how that can fit with a lot of the other energy stocks that we look at on in stock waves. and also with things like the UGA. UGA, which is the gas ETF. This can also still be a fourth, or got kind of high for a four, and really this can easily fit with what we're looking at in a lot of the other energy stocks, where this is just a larger A and a wider flat for a B wave. And while that drops under ideal support for the fourth wave, it is still within normal fibs for being an ending diagonal. So because this is getting a little bit high for a fourth wave of an ending diagonal C wave. So just looking at this as the alt larger A, B of a fourth is not such a bad idea. Or again, you could do the same thing that we were looking at in oil, where this is a W and an X, and then this is an A, B of a Y wave. So that might come down a little bit under the 43 region, but not break much under 40 to 37 as A, B, C of Y. But I would still certainly be on the lookout for this either being an alt A and B, or maybe even being 1, 2 of an ending diagonal for that C wave on gasoline ETF. And then looking at, well, I'm probably not going to look at natural gas because I hate the chart and it doesn't have anything clear to me. So let's move on to precious metals. On gold, let's see, we want my big macro clean chart. We'll zoom out here. Yeah, Robert, I'll get to TLT and bonds shortly. We're trying to look at this as holding as an A and a B wave last week, but it's dropping under support for that to be an A and a B inside wave one of a leading diagonal. So it does look like this is going to make a lower low as this C wave of primary wave 4. And I'm not exactly sure how that best counts. I don't know if we should move the A and the B wave here of the fifth, or to just count this as some awkward extension, as maybe 1, 2, 3, a high fourth wave, and then the fifth of that C wave for just an alt nominal lower low. But it does look like this is going to try and break the 1620s and make a lower low. And if that's the case, it can easily drop down to the next fib level for the C wave, which is down here at 1580. We are still trying to hold around the 382 retrace of the primary degree wave 4. I really don't want to see this drop all the way down to the 1530s, but that is also another fib region of fib confluence as the 50% retrace in the 1382. And so if this is an alt A and a B wave of our orange fifth of C, then that could stretch all the way down towards the 1530s as A, B, and C of that more extended fifth wave. But from here, it does look like maybe we just get a capitulation drop that starts to look like it's only going to tap under 1620, but then spikes a little bit lower to 1580 and then gets a stronger reversal than this. And then if that is the case, then we can restart this wave 1, and it can just be a regular impulse and does not need to be a leading diagonal at that point. So that new impulse would look something more like this. But while it might be worthwhile to try and look for a few speculative bids in that 1620 to 1580 region, certainly want to wait for more of a 5-wave move up off the low and a 3-wave retrace, at least a 5 up and 3 down as a small circle 1-2 start to a new wave 1, rather than just trying to speculatively buy at new lows and continue to drop to new lows. At the same time, silver is holding a higher low better relative to gold at the moment. So clearly only 3 waves up off of the September low, but holding as an ABC retrace just under the 764 and a possible move up and corrective retrace from that. So if the 18 level breaks, then it's probably going to tap a new low closer to the 1670s again. But as long as 18s hold, and really ideally 1825, then this can be set to head up towards 2223, still in part of that leading diagonal. Now with regard to GDX, I'm going to zoom out here to the larger pattern. Again, similar to gold, if gold is going to break under 1620 and drop down towards 1580, then it is very possible that GDX is going to get dragged a little bit lower in its C wave of this B. But we're looking at most of the gold stocks that are holding retraces look like this similar A-B structure inside a primary degree third of a much larger diagonal. So we're going to be looking for a 5-wave move up to start as the C wave. Most of those should be looking at somewhere towards a measured move or 1, 2, 3, 6 fib extension. Some of charts have already started to really break down, and we're not holding support already back here, and so they have already broken this low, but most of the major names are still holding within 50% to a 618 or a 764 retrace as that larger B wave. All right, let's move on to bonds. We do have to strongly consider the potential that the treasury bonds, go to the 2-week, which the history that I have goes back to 1981 to a major low in September 1981. Off of that September 1981 low, we can count ABC up for wave 1, AB a very drawn out C wave for the third, whether we count it into the top here or the top here, and then either this was all of a fourth and all of a fifth, which is a significant risk. And so that means that this drop here is not part of a C wave or a Y wave of the cycle wave 4, but just the start of a major retrace from this huge move up off of the 1981 low. But even if that's the case, we do look like we're completing an ABC move down from that 2019 high, or 2020, February 2020 high, and due for a pretty significant bounce, which should take the 30-year treasury up towards the 155 to 160 region, would be the normal resistance for a larger bounce to start. My preference, though, is that this is an expanded flat for a cycle degree wave 4, and that we can get one more longer term run to new highs for the 30-year treasury, at least nominally over the 199 to 200 region. But all of those are going to have the same potential count off of a low, because if it is getting a cycle wave 5, that's going to be a larger ABC corrective move up because it's part of a big diagonal. And if we're just getting a corrective bounce into that 155 to 160 resistance region, that would also be a corrective ABC up move. So this ABC move up could be part of that corrective bounce, and then we get a much bigger measured move down corresponding to this initial move. But ideally that should be from that initial resistance region, and that could even just be the A wave of the A wave in our larger cycle degree wave 5. But shorter term, we still continue to extend lower. The few little attempts at reversal have not given us 5 waves up, and even if they have given us something that might passably be considered 5 waves up, they haven't been able to hold any retrace support. So we can certainly apply a full Elliott wave count and see lots and lots of divergence and other things on the charts. But until we get something off of the low and then a higher low that sticks, these can continue to just be broken. Lynn will certainly tell you that it looks like there's a lot broken in the treasury markets that is very, very concerning. I think at this point, we're not going to get a B wave. So this can either count as the fourth of the C wave of the Y wave, or in yellow, it can just be 3, 4, and 5 of a C wave in yellow, C wave of the same cycle 4. So same ABC down either way. but continues to stretch and extend, and we're kind of in between fibs also at the moment, with the next fib for the larger C wave extension all the way down here at 116, but we have a 382 retrace if this is a cycle wave 4 at 117.2, and I think we're well past normal fibs for the Y wave that are very helpful, although we have one here at 120. Similarly, we can look at the 10-year and can see similar potential. Looks even better in my view as this expanded flat at the larger degree, but off of this high, it is more clearly like 5 waves down. That could be a good thing because it could be 5 waves down as a C wave, as A, B, C of 4 instead of the WXY. But we do have to be concerned that this was a major top, and that this is just 5 waves down from a major top, get a corrective bounce that might only get to 125, maybe up towards 130, and then another measured move to the downside, as starting with an equal proportionate move to this entire move down that we saw from 2020 highs. Translating that over to TLT. Here we go. TLT does not start at the same spot. It starts in 2004 was the low for the TLT chart. So from 2004 low, it is possible to count 5 waves up as a leading diagonal, but that really doesn't fit with what we're looking at in the larger treasuries. So in the treasuries, this is most of the C wave of the third, and then this bigger ABC drop can be the fourth. So rather than looking for a measured move that is long-term bullish off of a 764 retrace, we can count TLT as a larger ABC down and look for maybe an ABC up to a nominal higher high. And maybe that's just going to be the B wave of a larger flat. The issue with ETFs like this is that there are people that are looking at just the TLT chart, and trading just the TLT chart. But the TLT chart itself is based on a blend of the 30-year and 10-year bonds. So it's very important to keep track of the underlying counts in those instruments, and take that into consideration when you're looking at TLT, because it doesn't give you the entire picture. At a smaller degree, again, inside this 5th wave of the C wave, we can count 5 waves down trying to complete. It is very close to a fib. It does look very, very complete, and it's just under the 764 in purple. That's kind of the 76.4% fib is the last reliable fib support. Our ideal zone is the 382, the 0.50, and the 618. The 764 is a valid fib, but it is not the most reliable. And then as the further you get under that, the less reliable you are for something holding support. All right. Let's quickly take a look at the dollar. And then I don't know what else I might be missing. There are a couple other metals that we follow in the Metals, Miners, and Agriculture service that are looking pretty good. Copper still has a nice setup, and we just posted a wave setup on platinum, but I know those aren't normally covered here. I can see potential for a pretty significant top in place in the dollar, but we don't have a lot of clarity off of that high yet that a major reversal is starting. Whether this is an A, B, and then 1, 2, 3, awkward 4, 5 of C, or whether this is just a diagonal up, complete in purple as 1, 2, 3, 4, and an ABC for the 5th wave. Both of those counts have the same A, B, C for their respective fifths, whether that's the primary 5 of C or this purple 5th of the diagonal. But off of either of those, we don't have any kind of clear reversal. This can count as 5 waves up and only 3 waves down so far. So that could be setting up for even more extension of the dollar. That would certainly probably fit with another drop lower towards that 1580 level that we talked about in gold. Anything else I'm leaving out, guys? You're welcome for the discussion of the 764, Jonathan. Any other questions before we hold it over here? All right, well, I will get this uploaded for you guys, and any other questions, feel free to post them in your respective chat rooms, whether it's on the EWT side or on Seeking Alpha. Have a great evening, everybody.